SoFi, AMD, Apple, Qualcomm, Shopify, Lyft. Those are a number of the companies that just came out with earnings this week. And in my opinion, could present great opportunities to be trading options, selling options to create weekly, monthly passive income. Welcome to the channel, and if you're new here, I'm going to cover some option strategies and some examples that you can utilize to create weekly or monthly passive income selling some options. It is after hours, so take that into consideration when going through these examples, but the same approach can be taken during the week when you're looking at stocks and options to trade. So taking a look at the first example, Apple, let's take a quick dive in. And at the end of the video, if you learned something, you found value, I'd greatly appreciate it if you could like, subscribe. It really helps out the algorithm and the channel since it's a bit newer and we're still growing. So for the first example, I'm going to cover Apple. I'm sure everyone knows what Apple is. They just came out with earnings, and as you can see, they were fairly positive. And over the past 3 months, Apple's continuously moved upward from a low of around 145 approximately all the way up to now the peak of 173. So this one's actually really interesting because if you look at the advanced chart, you can actually see Apple's fairly oversold when looking at the RSI. So I'm actually going to walk through a credit spread example, more specifically a call credit spread, which is going to be a little bit more bearish of an approach and strategy. So let's take a look at what that's going to look like. So I'm in Robinhood, and you're going to navigate to the options section. And the first thing you're going to want to do when trading a call credit spread is look at the expiration date. For most of these examples, I personally like looking at options that are about 30 to 45 days out, just because you can maximize theta decay. The whole point of selling options, in my opinion, or one of the key points, is optimizing and utilizing theta decay. Taking a look at that, we're going to switch it to 42 days, so June 16th. And remember, this is after hours, so take that into consideration, but the same approach structure can be applied on any stock when the market is open. So you're going to go to sell call, and you're going to take a look here. In the next month, where do we feel Apple likely won't go above? It's already gone up pretty significantly over the past few months. I would assume there's likely going to be a drawback at some point, but I can't tell the future. But what you're going to do to set up this call credit spread is you're going to have two options tied to this. You're going to first sell a call, and then you're going to buy a call. So let me walk you through what that looks like. So let's take a look at the 185. So I'm assuming Apple won't go above 185. So I'm going to sell this call for 185. And as you can see, if I just sold this, it'd be a covered call. You'd collect $1.12 per share. So in one contract, there's 100 shares. So it'd be $112 credit. But I don't have 100 shares in this account. I don't want to sell a naked covered call. So what I have to do is protect myself. I have to purchase a call, a leg higher or a couple legs higher, depending on the spread you want. But for this example, I'm going to buy a leg 5 points higher. So this is effectively maximizing my profit, but also maximizing my loss. So what's going to happen here is the total credit I'd earn is going to be $67. So effectively, it's the difference between $112 that I would get credited today and then effectively a debit of $45. So if I were to trade this today, I would receive $67 in my account. And what are you risking could be the key question. So effectively, you're risking the $5 or the spread between the two strike prices. So in theory, you're getting $67 for putting up $500 of collateral. So that's over a 10% return in 42 days. So that's a fairly great return, in my opinion. If you consider doing this every single month, that's a great ROI. Again, you're going to have to take into account what strike prices make sense for you, what kind of risk to reward ratio you are looking for. So definitely keep that in mind when choosing the strikes that work best for you. Now, the second stock I want to take a look at is Meta, or formerly known as Facebook. As you can see here, the stock has recently jumped up massively after earnings, but I still think there's a lot of momentum here for Facebook or Meta to continue this upward trend. So I'm actually going to take a look at some put credit spreads, which are definitely a little bit more bullish. So about the opposite approach of Apple. But again, if you are bearish on this, you could look at selling call credit spreads. That's totally up to you. So what you're going to do for this example is you're going to go to trade options on the bottom right, And again, you're going to change the expiration date. So I'm going to go to June 16th, about 42 days. And I'm going to go to sell and I'm going to go to put. So I'm setting up selling a put here first. So again, this is more of a bullish point of view and stance on Facebook. So what I'm going to do is, how low do I think Facebook may drop if it does drop? And if you saw before, it was kind of trading around that 210, 215 point for quite a while before this recent jump up. So I feel pretty good trading this put credit spread around the 215 mark. So let's just take a look at what happens there. And we can even be more conservative and go a little bit lower. So let's look at the 205 and start with that. So let's sell this put. So effectively, if we sold a cash secured put, we would collect $223. But remember, we want to protect ourselves. So we're going to choose a strike price one leg lower. So we're going to go to buy a put. And now I'm going to go to the 200 and I'm buying the 200. And you can see the total credit of $46, and you'll notice the profit is 56, and that's purely because it's after hours, so it's just not lining up from a bid-ask perspective. But directionally, this is what you could be looking for when you're in Robinhood trading a put credit spread. So if you traded this type of setup, you'd effectively get a 10% return. If you think about it, you're putting up 500 of collateral again, you're going to collect roughly $50. You could be a little bit more aggressive and collect even more. So let me show you what that looks like. So I'm going to exit out of those. I'm going to go back to selling a put. And let's take a look at the 215 like I mentioned before. So here you can see there's a delta of 0.22. Let's select that. So you're going to sell that. In theory, if you sold a cash secured put for 215, you would collect $385. But now we're going to choose buy a put and we're going to go one leg lower. So now if you add that, the expected credit in your account today would be about $80. Effectively, what's happening here is this is 15-20% return. We'll have to see where the market opens with these specific strike prices in these credits and debits. But directionally, these strike prices would result in a much higher ROI. But you have to consider Meta has to drop, 10% to get down all the way to 215, 210. So the key question to ask is, do you think Meta will drop that far in the next 42 days, or will continue on that upward trend after the earnings have come out? And the next example I actually want to go over is for Accenture. I'm actually going to go over put credit spread as well for Accenture because, as you can see, it's declined a fairly good bit, and earnings did just come out recently. So I think there could be opportunity for it to bounce back. And as you can see, it's kind of been trading sideways for almost a year now. And after this drop, I don't think maybe it may not go that much lower. So I'm taking a little bit more of a bullish stance. I think there could be great growth opportunity once this, potential recession turns around and maybe the business grows. So let's take a look at some examples for Accenture and what those put credit spreads could look like. So let's change the expiration date first. Let's go to put. Let's go to sell. It's currently 265. So let's take a look at the 250. Let's sell that one, and then let's buy one leg lower. So we're going to go 5 points lower. So we're going to choose the 245. And here the delta is 0.17, so roughly 17% chance of, expiring in the money. So I'm going to select that. I'm buying that put. So total credit of about $50. So that's about 10% return for putting up $500 of collateral, the spread between the 250 and the 245. So a 10% return in 1 month's time frame. So very similar to Meta and Apple also. But the key thing to consider is, are you bullish or are you bearish? Do you think Accenture is going to go down to 250 over the next 42 days? Or do you think it's kind of bottoming and it may recover and continue moving upward? So, this put credit spread could be the right strategy. If you're bearish, then a call credit spread would be the approach and path you want to go down. The last example I want to go over is actually a little bit different than the first three. So as you can see, Lyft, they recently came out with earnings and actually got fairly crushed. They are down 15% since earnings came out over the past week. For Lyft, I'm actually going to show you the cash secured put. And the reason I'm going to show you that is because I think it's fairly oversold at this point. I hope there's a road to recovery. So I think getting in at a lower price than where it's currently trading of $860 could be a great value opportunity for owning Lyft if you're bullish on the company for the long term. So let's take a look at Lyft and see what we can do here and what the options are and what the premiums look like. Something I'm going to do a little bit different is I'm actually going to look at the 7 day, so 1 week cash secured put for Lyft and kind of looking at what that return looks like. So if I were to sell a put just 1 week out, trading weeklies is fairly common. So if I were to select the $8 put and say, hey, I'm willing to purchase Lyft at $8 if it goes down that low in the next 7 days. But to do that, pay me $11 today, and if it drops below 8, I'll buy it. So what's interesting about this is actually a 1% return, even over 1% return in a week if you take a look at the credit and the total capital that you're putting up to potentially purchase Lyft. So if you annualize that, that's pretty crazy. It's a 52% return. And if you start with a weekly option, you actually have the flexibility to roll it if the option goes against you. You could buy it back and sell it again at a different strike price for a different premium and hopefully continue to collect the credit. So this one's actually very interesting because of the ROI you can get. If you're confident in Lyft recovering after this massive drop, you could sell an 850 put, and you have to have $850 in your account to be selling this. But if you look at the ROI standpoint, it's roughly 3% return in 1 week. That's pretty aggressive in my opinion, but that's pretty impressive at the same time. So worth considering weekly options. So those are all the examples for today's video. If you found value, like I mentioned, I'd greatly appreciate it if you could like and subscribe. And also feel free to check out any of the links down below for some of the awesome resources that I use on a day-to-day basis. Hope you have a great one and look forward to the next video.